Hello dear friends. Today let's talk about what are isolated margin and cross margin. Isolated margin and cross margin are two different margin types available on many cryptocurrency trading platforms. The choice between isolated margin and cross margin boils down to an individual's trading strategy, risk tolerance, and how actively they wish to manage their positions. Before we get to isolated margin and cross margin, let's have a brief overview of margin trading. In margin trading, investors borrow funds from an exchange or broker to buy or sell more assets than they could afford on their own. They use the assets in their account as collateral to take on debt and make larger bets, in the hope that they will earn a bigger profit. Let's say you have $5,000 and think the price of Bitcoin will increase. You could either buy $5,000 Bitcoin directly or leverage your position to trade on borrowed funds. Suppose the price of Bitcoin increases by 20%. If you had just invested your $5,000 without leverage, your investment is now worth $6,000, $5,000 initial plus $1,000 profit. That's a 20% gain on your initial investment. However, if you had used 5-to-1 leverage on your $5,000, you would borrow 4 times the amount you have and boast $25,000 to invest, $5,000 from your original capital and $20,000 as a loan. With a 20% increase in Bitcoin price, your $25,000 investment is now worth $30,000, $25,000 initial plus $5,000 profit. After you pay back the $20,000 loan, you're left with $10,000. That's a 100% return on your initial $5,000 investment. Remember, margin trading is highly risky. Let's consider the opposite scenario where the price of Bitcoin drops by 20%. Your $5,000 investment without leverage would be worth $4,000, $5,000 initial minus $1,000 loss, suffering a 20% loss. But with 5-to-1 leverage, your $25,000 investment would be worth $20,000, $25,000 initial minus $5,000 loss. After paying back the $20,000 loan, you'd be left with nothing, losing 100% of your initial investment. This simplified example does not include trading fees or interest that might be payable on the borrowed funds, which would reduce your profits in real trading scenarios. It's important to remember that the market can move quickly, leading to potential losses that could even exceed your initial investment. Friends, if you want to trade on spot market or trade futures on top crypto exchanges with promo bonus, just use links under this video to register an account and you will get additional bonuses up to $30,000, depending on the exchange, which will be available in the Rewards Hub after signing up. Okay. Let's continue. Isolated margin and cross margin are two different margin types available on many cryptocurrency trading platforms. Each mode has its own utility and risks. Let's understand what they are and how they work. In isolated margin mode, the amount of margin is limited to a specific position. This means that you decide how much of your funds you want to allocate as collateral for a specific position, and the rest of your funds are not affected by that particular trade. Let's say you have a total account balance of 10 BTC. You decide to open a leveraged long position on Ethereum, betting that Ethereum price will go up. You allocate 2 BTC as the isolated margin for this specific trade with 5-to-1 leverage. This means you are effectively trading with 10 BTC worth of Ethereum, 2 BTC of your own money plus 8 BTC leveraged position. If the price of Ethereum goes up and you decide to close the position, any profit you make adds to your original 2 BTC margin for this trade. But if the price of Ethereum drops drastically, the maximum you can lose is your 2 BTC isolated margin. Even if your position gets liquidated, the other 8 BTC in your account remains untouched. That's why this is named isolated margin. Cross margin uses all available funds in your account as collateral for your trades. If one position moves against you, but another position is in profit, the profit can be used to cover the loss, allowing you to keep your position open longer. Let's see how this works in an example. You have a total account balance of 10 BTC. You decide to open a leveraged long position on Ethereum and another leveraged short position on a cryptocurrency we call Z, using cross margin. For Ethereum, you effectively trade with 4 BTC worth using 2-to-1 leverage, and for Z, you trade with 6 BTC worth, also at 2-to-1 leverage. Your entire 10 BTC account balance is used as collateral across both positions. Let's say the Ethereum price goes down, causing a potential loss, but at the same time, Z's price also goes down, leading to a profit for your short position. The profit from the trade on Z can be used to cover the loss from the Ethereum trade, keeping both positions open. However, if the Ethereum price drops and Z's price rises, both your positions could be in loss. If these losses exceed your total account balance, both positions could be liquidated, and you can lose your entire account balance of 10 BTC. This is very different from isolated margin, where only 2 BTC that you have allocated to the trade is potentially at risk of loss. Remember, these are very simplified examples and don't incorporate trading fees and other costs. Additionally, real trading scenarios are usually much more complex. From the examples above, we can clearly see the similarities and differences between isolated margin and cross-margin trading. We can summarize their key differences in the following way. In isolated margin, only a specific portion of your funds is set aside and at risk for a particular trade. This means that if you're trading with 2 BTC in isolated margin mode, only those 2 BTC are at risk for liquidation. But in cross-margin, all the funds in your account serve as collateral for your trades. If one position goes against you, the system can utilize your entire account balance to prevent that position from being liquidated. But you risk losing your entire balance if things go really badly across multiple trades. Isolated margin allows for more granular risk management. You can allocate specific amounts you are willing to risk on individual trades without affecting the rest of your account. Cross-margin, on the contrary, combines the risk across all of your open positions. It can be beneficial when managing multiple positions that might offset against each other, but the combined risk can also mean potentially higher losses. In isolated margin trading, you have to manually add more funds to that isolated margin position if you want to increase the margin. On the other hand, cross-margin automatically utilizes available balance in your account to avoid liquidation of any position, making it more hands-off in terms of margin maintenance. Isolated margin is suitable for traders who want to manage risk on a per-trade basis, especially when they have a high conviction about specific trades and want to keep risks separate. Cross-margin is more suited for traders running multiple positions that might hedge against each other, or for those who want to leverage their entire account balance while having a more hands-off approach to margin maintenance. Now let's look at the pros and cons of isolated margin. Controlled risk. You decide how much of your funds you want to allocate and risk for a specific position. Only this amount is at risk, keeping the rest of your funds safe from potential losses in that particular trade. Clearer profit and loss. It's easier to calculate the profit and loss for an individual position when you know the exact amount of funds tied to it. Predictability. By segregating funds, traders can predict the maximum loss they can face in a worst-case scenario, aiding in better risk management. Requires close monitoring. Since only a specific portion of funds is backing a position, you might need to monitor the trade more closely to avoid liquidation. Limited leverage. If a trade starts to move against you and nears liquidation, you can't tap into the rest of your account funds automatically to prevent it. You'd have to manually add more funds to the isolated margin. Management overhead. Juggling multiple isolated margins for different trades might be complex, especially for beginners or those managing numerous positions. In summary, while isolated margin provides a controlled environment for managing risks in leveraged trading, it demands more active management and can sometimes limit the potential for profits if not used judiciously. Here are the pros and cons of cross-margin. Flexibility in margin allocation. Cross-margin automatically uses any available balance in the account to prevent liquidation of any open position, providing more fluidity compared to isolated margin. Offsetting positions. Gains in one position can help offset losses in another position, making it potentially useful for hedging strategies. Reduced liquidation risk. By pooling your entire balance, there's a lower risk of premature liquidation for any single position since a larger pool of funds can cover margin requirements. Easier management for multiple trades. It simplifies the process when managing multiple trades simultaneously since you don't have to adjust the margin of each trade individually. Higher risk of total liquidation. If all positions move unfavorably and the combined losses exceed the total account balance, there's a risk of losing the entire account balance. Less control over individual trades. Since the margin is shared across all trades, it becomes harder to allocate a specific risk-reward ratio to individual trades. Potential for over-leveraging. With the ease of leveraging the entire balance, traders might be tempted to open positions larger than they would with isolated margin, potentially leading to greater losses. Less clarity on risk exposure. It's harder to gauge the total risk exposure at a glance, especially if there are multiple positions open with varying degrees of profit and loss. Margin trading, with its potential for increased profits, comes with an equivalent, if not higher, degree of risk. The choice between isolated margin and cross-margin boils down to an individual's trading strategy, risk tolerance, and how actively they wish to manage their positions. In crypto trading, where volatility is often the name of the game, understanding the intricacies of both margin types is paramount. A well-informed decision, coupled with diligent risk management practices, can help traders navigate the turbulent waters of the crypto market. As always, it's essential to do thorough research and, if possible, consult with experts before diving deep into margin trading. Friends, I'd like to remind you, if you use my links to register an account, you will get additional bonuses up to $30,000, depending on the exchange. That's it for this one. Click like button and subscribe to our channel. Thanks, and until next time.